Today I'm joined by Heston, a lender with BOK Mortgage. Karen has over 30 years in the real estate industry here in Oklahoma. She's bringing a wealth of knowledge to the table today. And let me tell you, her background includes real estate sales, appraisals, corporate relocations, bank foreclosures, title closings, and mortgage lending. Listen in as Karen tells us about what the good news is when we're looking into 2023. Welcome, Heston, to the show. I'm so glad to have you today.
Thanks, Christi. I'm glad to be here.
Yeah, I'm so excited. We recently got together and we were talking about this, and I knew I had to have you on based on some of the things we were talking about. Tell me a little bit about your real estate journey. I know you said that you've been at over 30 years, so you have massive amounts of experience that you bring to the table. But it sounds like you've been on the real estate side as a realtor, broker. You've done appraisals, and now you're lending. So you really kind of seen all of the things in our industry.
I have. And I will say this, that starting out as a realtor was probably the very best education I could have for the additional steps that moved my career forward. And it also gave me a very good insight on what a realtor needs and wants. So I would have not given up this career path in retrospect at all because it was a really good education.
Nice. Okay. So let's talk about what your thoughts are going on in the market.
Here's the good news. The really good news, and this is of recent, rates are finally coming back down. So that's helping a lot. And I have seen the market pick back up a little bit. It's definitely slower than it was the last year to 2 years. It's more of what we would say a normal market is,
right?
Which the last 2 years have not been a normal market. It's been an abnormal market. And it's a little bit slow this time of year anyway, but like I said, I've definitely seen it pick up. And I had a customer yesterday lost out on a transaction. There were 11 offers on.
Wow. Okay.
So some of that is still happening.
That.
The house was priced well because I looked at it with them. I didn't physically look at it, but I saw it on pictures and I could see that it was priced well. So those things are still happening.
That's really good news. Yep. Because everybody's afraid like we're going to be sitting on some inventory. And I know that you've seen it and I've seen it where inventory would be on the market for on average 60 days and we're nowhere near that. And that was normal.
I think the appraisal, the normal market time is up to 120 days is what was considered a normal market time. So yeah, we're not seeing anywhere close to that. And unfortunately, you're seeing also with sellers like, oh my gosh, it's been on the market a week and we don't have any offers. And
yeah, exactly.
Again, that's abnormal. That's not normal.
So where are you plugging into right now to get your information?
I listen to a lot of mortgage industry podcasts. Right now, there's a company called Mortgage Market Animals or Mortgage Animals, and they do a lot of interviewing with free professionals who are doing like tons of volume, like hundreds a month volume. Wow. And so I'm listening to a lot of that right now in the news, local as well as national. I think the best source is the boots on the ground folks, you guys. And what are you seeing and what are you hearing? And then same with us. How many calls are we getting and how slow are the phones? And it's definitely slowed down. But as the interest rates are going back down, I'm picking up the phone and saying to these people that rates are coming back down, hoping to motivate them a little bit.
So basically you're pivoting your marketing approach a little bit.
Yeah. Okay. I mean, I had another conversation earlier this week. And when things slow down, and again, I hate to say we're slow because I really think this is more industry normal.
Yeah.
You guys as realtors and us as mortgage people, you have to go back to the basics. You go back to what do? You go back and you pick up the phone and you call people and you call your past prospects. You just do everything we've been trained to do through all the years. And then we get busy and then that kind of falls to the wayside because we don't have to. Now we're just doing the marketing functions that we know we're supposed to be doing all the time. And sometimes they get left behind when we get super busy. So
yeah, we're just back to the fun stuff.
Yeah, it is.
Karen, when we talk about interest rates, and I know you don't need to quote or anything, things are changing every day. What are you seeing them doing right now? And what are you anticipating for 2023?
There's a lot of opinions. What we do know for sure, and this came out recently, inflation does seem to be taming. And that's very good news for mortgage rates. Now, that may not be so good for overall economy because as what's causing inflation to tame is some of the painful things that the Fed chairs have been talking about. But the financial markets and the money markets is such a finesse line. It's finicky. Inflation is not a good word in the mortgage world because that means it's going to push rates up.
Yeah.
And it's a balance. But the predictions are that we are expecting to see rates drop back into the fives this coming year.
Good. That's good.
And I actually talked to a money manager for a very large financial nonprofit group this week. And he was in New York City speaking to his money people. And they're predicting that potentially the Fed rate could get back into the ones in 2024. Now, who knows? This is what I tell people every single day is everybody has an opinion. There are people on Wall Street making tens of millions of dollars a year, and they can be wrong. So it's as good as guess as anything. We just have to learn to adapt. When rates were pushing mid-sevens, my position was always, if this is going to be the new normal, let's just let it calm down. Let it be the new normal because people will start getting used to that. And then it will be the stories like you've heard, oh my gosh, when my parents bought a house back in the 80s, rates were at 16 and 17%. Those will be this opposite story.
Oh, yeah.
Man, remember when we got that mortgage?
2% interest.
I know. We got interest rate for free mortgage.
Yeah, pretty much. We got a house for free. When you're talking to realtors right now, what advice do you have for agents?
So we can all just have the same conversations with them about we don't know what tomorrow brings and maybe rates will come down. If you buy now and rates come down, we can always refinance. And Bank of Oklahoma is actually going to be starting a program where we're not going to require any lender fees on our internal refinances because that is anticipated to be coming soon. So people can take advantage of that. The other thing to focus on is so many buyers are payment conscious versus rate and price conscious. So if the payment fits inside of a budget, and then we can work on that too. Some other strategies could be, and again, it's going to depend on the situation in the home, but is a seller willing to help pay some closing costs and maybe do a permanent rate buy down on interest rate? Can we get that rate down to lower your payment? Yeah. And so those are just some strategies. I will say there definitely has been some customers who got qualified in December of 2021. And when the rates bumped, they no longer qualified for that price range. And that's very disheartening. There's still a buyer market out there, and there always will be. There will still be buyers out there for realtors. So we just have to go back to the basics and do what we do and keep moving forward.
We can't. We just have to find those solutions to help these people if they're going to be able to buy a house. Are you seeing a lot of people pulling their money maybe out of the stock market, putting it into that home?
I don't know that I've seen that any more than I have in the past. When rates were so low, I can't tell you how many times I would get a phone call and I said, well, I made this cash offer. I called my investment guy and he said, you are not pulling your money out of the market for when you can get an interest rate for whatever low it was at that point. And then your cash offer that you guys sometimes never knew as realtors, they became finance contracts.
That happened a lot.
It did.
Last couple years, yeah.
Honestly, some of it I really do believe was innocent because that conversation would happen over and over. People would be, I want to pull it out. No, you're not going to pull it out. So, it's there. There's still a lot of equity for step-up buyers. They bought their homes low and they're selling for much higher. And that's helping. But I really haven't seen that become any different all this year. It hasn't been any different.
What about refis? I'm hearing that they're pretty much dead right now. Is that what you're experiencing?
The only people who are refining are the ones who have to refi.
Yeah.
Yeah. So there's situations where somebody just has to, but they're not so
much. But other than that, it's pretty.
Matter of fact, my November closings, I had no refis at all. Zero.
Gotcha. Yeah. I hope everybody got refied while they could.
Yeah, it was nuts. Yeah.
Let's talk a little bit about some of the nitty gritty of the business. Talk to me about what a point buy down is. Some agents are still figuring out what those are. So what is a point buy down?
So let's talk about what a point is. A point is 1% of the loan amount. And when you talk about points, it can be a variety of numbers. It can be a quarter of a point. It can be a half of a point, which would be a 0.5% or a quarter of a percent of the loan amount. Or it could be some weird number like 0.337, which can happen too.
Okay.
So what the point does is it can potentially lower your interest rate. And any given day, there's not like a set amount of points you can buy to get a set amount of decrease in interest rate. That varies with the fluctuations in the market. So, for instance, if it was simple, it would be, okay, for every half of a point you pay, the rate would go down an eighth of a point. It would be great if it was that simple, but it's not. I looked the other day and the rates were very compressed, and I'm going to throw something out there and it's not going to be accurate, but give you an example.
Sure.
Of where it was that particular day. So it was somewhere like in the mid sixes, didn't have a point on it, but you could pay a point and get all the way down to 6 and an 8 or 6%.
And that's for the life of the loan.
Yes. So that rate would be fixed for the life of the loan. Correct.
Okay.
And so the math always would work out if somebody was actually asking me, does it make sense to buy these points? Is what's the difference in the payment and what's my payback period? So if it drops your payment $50 a month, but it's 100 months to pay back, the chances of you being in that loan start getting pretty slim. And right now, the media is doing a really good job of also reporting that rates are expected to go lower. And then there's other people with opinions that, are saying that they are. And then some customers just think, oh yeah, they'll go lower again. And so they're anticipating a rate reduction. And so then we have to talk about, okay, if you think rates are going to go down in 2 years, if it's a 5-year payback, do you really want to pay for this cost?
All up front.
Because it definitely is an upfront cost and it's permanent. Then there's things called temporary buy downs that you also pay for up front, and they are expensive. And it's one rate for 1 year, then it goes up the next year, and then it goes up the next year. So that's just temporary.
So are those called a 2-1 buy down versus a point buy down?
Yeah.
So agents can get a little confused on that and think maybe they're looking at a point buy down for their client that's going to last for 30 years, but in reality, it may just be the first 1 year.
Correct.
Or 2 years. Yeah.
So the buyers and I have those conversations too. And as a realtor is writing the offers, they're just asking for closing costs. So how those fees paid for the seller get allocated is up to us how we allocate them.
Gotcha. And you had mentioned too, Karen, when we talked recently, you were talking to me about assumable loans. You were saying that you can do assumables on conventionals as well.
Government loans are like FHA, VA, rural development, and FHA and VA are assumable. They always have been. Conventional loans, on the loan documents, it says that they are not assumable. At closing, the buyer is acknowledging that they understand these loans are not assumable.
Gotcha.
There is something called a special circumstance assumption on a Freddie Mac and Fannie Mae loan. And that would happen in the case of a death of an owner or a divorce. And this can be really important if somebody is getting divorced. One person may want to stay in the home. The other one is probably going to have to move. That was what I was going to say. Obviously, somebody's going to have to move.
Somebody's moving out.
Somebody's probably moving. I have seen some weird situations, but somebody's probably moving out. So it still helps the realtor that they may get another buyer out of that because that other person that's leaving the home. But it also may really be beneficial to the person who's staying in the home to not have to refinance. Because in the past, the industry assumption was that you had to refinance to get the other person's name off. But the special circumstance allows one of the people to actually retain the home and keep that loan. They get to keep the lower interest rate. So
that is great information for realtor helping people that are in a divorcing or family member passing situation that they don't necessarily have to go out and get full on new financing, that they can assume the loan. They do have to qualify, obviously, but they can assume that loan as is, especially if you did get those amazing interest rates.
Exactly. Now, I'm going to make this comment. Let me clarify. This does not pertain to government loans that are assumable, only conventional loans that are assumable. I could not go assume your conventional loan unless we were legally married.
Exactly. But the spouse can stay, keep their rate. The one spouse that's staying can keep their rate, and the other spouse can go and not necessarily have to be tied to that mortgage anymore.
Now, the only other tricky part in a divorce situation is a lot of times they're refinancing to pull equity out to pay the other person off. And in that scenario, it's going to have to be a refi. But I say that. I guess in theory, you could get a home equity loan on top of the first mortgage. But in most cases, they're doing that. But it's all about options and talking through scenarios. And let's see what the best thing is. But the special circumstance assumption for a conventional loan was actually news to me until about 5 years ago. And some of my peers are not even familiar that it's there. And the funny thing was, when you were asking me questions about it, and I made a couple phone calls internally, and then I actually called Fannie Mae too, because there was a comment made that maybe some lenders can opt out even on government loans on assumptions. And the
as
girl
an overlay?
Like an overlay. The girl who handles our assumption department, and it's just one of her many hats she wears, they're very cumbersome. And she goes, we tried to not do them, and FHA is absolutely not. Lenders cannot opt out of not doing an assumption on government loans, period.
That is good information. So do you think that we're going to see more assumable transactions?
We definitely have already started seeing assumptions.
Wow.
And they're tricky because they've really not been a player in the real estate world. Probably, what would you say, 20 years? A long time.
Yeah.
And our systems are not built to accommodate them. So my words to you and to the real estate community, even if it's a government FHA that loan that is assumable, all of it's done manually. So don't try to do a 30-day closing on back of an assumption, because it's not going to happen.
Or should we be looking at closer to 60?
At least 60. I would say at least 60.
Okay.
60
Good to
90.
know. Okay.
And it's really sad because we've become so automated. Everything's automated now, and everything is manual on it. Old-fashioned manual. It's
because
crazy.
Nobody's done them. They weren't necessary.
No.
So this is coming back. It's new for everybody, it sounds like. In your time, since you've been in industry for 30 years, have you done assumable loans? When was the first one that you did? Was it in the last couple of years?
The first one I did, I actually assumed a home when I moved to Tulsa.
Oh, did you really?
Assumed a mortgage. Yeah. Back in the day when there were still non-qualifying FHA assumptions.
Gotcha.
I was new to the city and a new realtor in the city, and I was able to assume that mortgage at 9.5% interest rate, I think is what it was.
And you were probably glad to get it.
Yeah.
That percentage, yeah.
And then I refinanced it, and at the time you didn't have to qualify. It was one of those non-qualifying, so I could still be a realtor. And but it worked out.
That's awesome. That's awesome. There seems to be this mystery, right? Once a file gets to you, client goes under contract, this underwriting, this mystery that goes on. Talk to us about really what's happening in that process so that realtors can better understand it and their clients through that.
Yeah. So the mystery underwriter. I laugh. Our underwriters who actually get out on Facebook. It's funny. Do you really want to get out on Facebook?
Yeah.
Or do you not say you're an underwriter if you're on Facebook? Underwriters really get a bad rap. And a lot of it is our fault as mortgage bankers because we always blame everything on the underwriter. And I explain to people the underwriter is really what I would call the quality control person. She or he is making sure that the data that I put in the application is accurate, that the data that we have to support or the documentation that we have to support that data matches. If I put in somebody's income is $100,000 a year and it's $25,000 a year, that's not the same, obviously. They're also making sure that loan meets the loan guidelines. And each loan product, FHA, VA, conventional, there's a manual for each of those loan types that there's guidelines set out. And they're similar, but there are definitely differences. So that's the underwriter's job, is to make sure that it fits within the box. An automated underwriting decision, it would be a manual underwriting decision, which means now you've got to fit inside of a box. So debt ratio has to be lower. There's other rental history we'd have to get and all that kind of thing.
So when it goes to manual versus the automatic, does that add some time to the process as well? Or are they still able to potentially get it done in the same amount of time?
It can be done in the same amount of time. The only thing that can add is, for instance, there almost always has to be a verification of rent if somebody's renting. And depending on the loan, sometimes it's a 2-year rental history. Usually it's only 1 year, but there are some programs that require a 2-year. So then it depends on how fast that landlord gets stuff back, how easy it is to get a hold of them. So just stuff like that. We have to have written verifications of employment in those scenarios. So again, there's more to do, and it's all about how quickly they get ordered and how fast those employers and the landlords get back to us too. It's not horrible, and it could still close at a 30-day timeline in most cases.
Well, that's good to know. That's good to know. But it's interesting to see. So essentially, there seems to be a team of people working together on the backside, making sure that the applicant matches with the requirements of the loan and the overlays of the company, and goes through all those hoops, and that's what takes that process. Now, as far as time frame, what's the turnaround? If realtor is going to be able to write a contract, obviously 30 days plus would be ideal. If there's a shorter time, or what's the average right now?
I've had some people trying to rush some things through, and I've been able to get some things closed in 3 weeks.
Okay.
It just depends. The whole appraisal process is on a rotation basis, and you just don't know which appraiser you're going to get. Some appraisers get out there and get them back right away, and some of them don't. Literally, I just had one this week. We ordered the appraisal on the 2nd. The appraiser went to the hospital and didn't notify us.
Oh, no.
We were supposed to have the appraisal back on the 13th, and he hadn't even been there yet.
Oh,
and
wow.
we actually were able to get a super rush. We ordered it on Tuesday, and we got it today. With a different appraiser.
Gotcha. Well, I hope he's okay.
I know. I do too. But it sure did put everybody in a pinch. Because, and if you think about it, I think we got that contract on December 1st, and we're closing on the 22nd. So
that's impressive. Yeah, that's impressive. Karen, what do you wish that real estate agents knew about the lending process that would make it easier for them, for you, for everybody? That would make it easier.
First of all, I would say, please complete the contract in its entirety, especially the realtor section that has the license numbers and contact information.
I know I could be bad about that. So,
we have to enter license numbers on both sides of the transaction. And then the crazy thing is, a lot of realtors will put their office number on the contract and not their cell numbers. And we work after hours too. And if you Google a realtor, sometimes it's hard to find a cell number. And some of the offices don't have after-hour answering services, so it's hard to get a hold of them. Then, of course, email, too, is important because, like, my assistant updates files through email. So just to have that email, just to make it more convenient to contact everybody in both sides, listing and buyer side. So
that is great information because I honestly didn't think anybody was looking at that. So absolutely, that's really good info to pass around.
And the reason why we have to have it is because every loan is run through something called Fraud Guard. And Fraud Guard is looking at the buyer, the seller, each realtor, me, the appraiser, and the title company to see if there's any fraud claims.
Gotcha. Good to know. I really didn't know that. And I bet you a lot of people out there don't know that. So that is great information.
Yeah.
I hope that we'll be able to get those contracts completed better as we're moving into 2023.
Yeah. I'd probably say about 80% are good, but
I think so. There's some people that are just detail oriented and they get all those checks and crossed and all that good stuff. And then there's a lot of realtors that are flying by the seat of their pants and throwing it together.
I get it.
And you could be the same realtor and it's just a different day.
That could be true too. And that's not different than for loan officers too.
Yeah.
But the other thing I wanted to mention about what I wish realtors would know is we're all here trying to get to the same goal. We all want to take care of that buyer. We all want to go to closing. And here's something I think I've actually mentioned it to many realtors that didn't know. I'm 100% commission too. I don't get a paycheck unless we close. So we can all go through all this work, and if something falls apart, none of us get paid. And I will be the first to say, personally, money has never been my motivator, but just to understand that we're here as a partner, and we definitely have an interest too. And we also want that customer to come back to both of us, right?
Yeah.
So let's do what we can do.
We're in it together. Let's talk about Native American loans.
Oh my gosh, one of my favorite loans ever. I actually have a publication out there with my name on it in one of the Native American publications on it. I love this loan. It's available for any Native American from a federally recognized tribe if you live in an area that's considered Indian territory, basically. In Oklahoma, the entire state is Indian territory. It is not tribe specific. So as long as you're a member and you live in an area, it doesn't matter which tribe you're from, you can live anywhere in that area. And the loan is fabulous because the down payment is only 2.25%. It does have an upfront mortgage insurance premium that gets
But it's lower than FHA.
It's lower than FHA, and it's rolled into the loan.
Okay.
And the monthly premium is much, much lower than FHA. It used to be 0, but that got changed. But it's only 0.25% for the year, compared to FHA is 0.85.
Yeah.
It's really a great loan. And like FHA, where the seller can still pay closing costs and that. Now, the only thing that's really tricky about it is there is not a credit score. They have in their guideline, there's not a credit score requirement, but they're really picky on credit. And even though they say that there's not a credit score requirement, anything that they're picky about would cause somebody's credit score to be low. So they don't like any late payments at all in the last 24 months. They want an explanation. They will probably have to be paid off. Any collections have to be paid off. So they're real picky about that. And they're very picky about debt ratio not being greater than 41% of their gross income. So those are probably the two pickiest things. But I love that loan.
Yeah.
I love it.
Have you seen a lot of them in the last couple of years, or did they get shelved a little bit and now they're coming back?
I see them constantly going on. The problem with the last couple of years was there were so many multiple offer situations that sellers had in their mind that they didn't want a government loan. Or if you have 10 offers and you have an offer that somebody's putting 2.25% down versus somebody putting 20 or 30% down, from the seller perspective, that's going to look like a stronger buyer.
Yeah.
So they're probably going to take that offer because the assumption is it's a stronger buyer than somebody that has a minimum amount of down payment. It was really tough for those veterans and those Native Americans to get a contract accepted. So that would have been the only reason why I saw fewer of them, just for those reasons. Need is out there and the desire is still out there equally. Now,
So if you're a newer agent, who's not familiar with the Native American 184, get with your lender right away and get those details.
Yeah. Yep.
Yeah. So many people in the state do have their Native American tribal card. So absolutely. Okay. What about USDA loans?
Yes, we also referred to as rural development, or we'll use the acronym RD.
RD.
Those loans are for homes that are in rural areas, and that's defined by population. And there's a map out on the USDA site that you can actually put in an address to see if it's eligible or not. It's a little bit tricky to find, the map is, so somebody can just call me and ask me. But that is 100% financing, so there's no down payment requirement.
That's phenomenal.
The loan also allows the seller to pay closing costs up to 6% of the purchase price. So again, if we get back into more of a normal market and the seller is willing to, the buyer theoretically could get in for little or no money.
Yeah, zero.
Yeah. And Christi, what kills me is I'll see houses that I know are rural development eligible. I think realtors really miss a chance on using that as a marketing tool.
Yeah.
Because that's a really strong marketing tool and really could help a lot of potential buyers. Because, a lot of people are just afraid that they can't buy because they don't have 20% to put down. And I may be jumping the gun on one of your questions because that was going to be one of my answers. One of the biggest misconceptions in the industry is, and I'm going to throw her name out there because she drives me crazy. Barbara Corcoran is on the news all the time. And she's out there nationally always saying you have to have a 20% down payment to buy a home. And that is not true.
Maybe it's been so long, she's only been buying investment properties. She only sees the 20% down she's got to put in for her investment property.
Well, the other is that she works in New York City where everything's $1 million and everybody's rich. So she only sees 20% down. Yes, that drives me insane. She almost every time she does an interview, she says it. And I just I actually literally say out loud, I scream through the TV, no, that's not true. You're sending the wrong information. So it is not, and I'm going to jump to this because you may ask the question, but not only are there loans like FHA that has the small down payment, like a 3.5% down payment, there's also down payment assistance programs that people qualify. So again, it goes back to why if you're not buying in a rural area, that is 100% loan. If you're buying in a more urban area that would qualify for FHA and you need some help with the down payment, there's those down payment assistance programs that you may qualify for. Then again, if you get money there for the down payment and the seller can help with closing costs, then you can get in again with need loans I've done with there was no out of pocket. They would get their earnest deposit back at closing, and I know the market's tight.
Buyers are always shocked. What? But yeah, absolutely. Get that down payment back. So talk to us about some of those down payment assistance programs. What are some that you would recommend that realtors look into?
The one I use the most is probably OHFA, Oklahoma Housing Finance Authority. And this is going to be on a podcast, so anybody could log in and hear this from any other state. But they are state specific. So check locally with your state and some of your municipalities. To see if something, because Tulsa County actually has a program through Housing Partners of Tulsa. They have a program also that has a much lower income requirement. All the down payment assistance programs have an income requirement. Some of them have a pretty high down payment requirement where the majority of the population will fall into. So again, talk to a lender and ask them the question, but they are out there and available if that's the only way you can get into a home. There usually is a bump in interest rate on those. And so it's maybe not the best way to get into a home, but some people it's the only way to get into a home. And I know you and I are in the business and it's our job, but buying a home is the first step in obtaining individual wealth there is.
Yeah.
And so it's a huge accomplishment to get into your first home and start that lifetime of financial success.
Absolutely. Absolutely. What program would you recommend realtors look at right now that has money left still at this time of the year?
You know what's crazy is you're reverting back to the old days where OHFA used to have a limit.
Cut off, yeah.
We would get an email and we'd go, okay, here's money.
Yeah.
Hurry up and get your contracts in. And then it would run out and then we'd have to wait again.
Yeah.
They've not run out of money for years.
Nice.
So that's not been a problem. Some of the municipality programs like Tulsa Housing Authority, they do run out of money. And so they have to get voted on and reallocated. Again, just check to see. And there's other options, though. If they don't have money, there's other options.
So what I'm hearing, too, is if you have somebody who wants to buy a home, who wants to be a homeowner, doesn't necessarily believe that they can or doesn't know if they can, the first step is really getting them with a lender who's knowledgeable on these products, not just with the best rate out there. A lot of times that's what they're always looking for is the best rate, but somebody that can guide them through to get them into that home ownership with all these different tools or whatever might fit for them.
Sure. And again, it's all about asking questions in discovery. What do you have? What do you need? And sometimes there may be some credit challenges. The thing I want to say is, if you've had credit issues in the past, that's not a lifelong sentence. It can get better. It might take some time and some work, but it can get better. And I've seen people's credit turn around and they get to achieve their goals.
Yeah, absolutely.
What home ownership means to me. I'm from a family who my grandparents lived in the same house for 55 years and very conservative financially. And you didn't buy something because it was pretty. You only replaced it when it broke. And that was instilled in me. I signed the contract on my first home on my 18th birthday.
Wow.
I was 18 years old and we closed a couple of months later. So I've been a homeowner early on and I wasn't in the real estate business at that time. And then I got into the real estate business because I thought it was interesting. And watching how owning a home and being a homeowner, how it can change people's lives, and not just because it's the dream, yes, but it's something that you work for every day that's yours and that you're able to make changes and make it yours. And then not just owning that piece of earth, but then the whole building of wealth because of it. And you've seen it over and over. What I didn't mention is both my kids got into their first homes on the Native American loan, their Cherokee. And that's not the only reason why I love it, but that's a reason. And they both bought their homes. My daughter 15 years ago, their first home, and my son about 10. And those homes have appreciated more than double in that timeline. And my son is at the point where he's looking to buy up. And yes, homes are more expensive now, but he is going to be able to buy his next home and have more than $100,000 down payment because of being in that home. And that's, excuse me, that's the kind of equity and wealth owning a home can build. And even if you lived in the same home for 30 years, eventually you're going to pay that off and that's going to be yours. And then you just live there for the taxes and insurance. And then you may have something to give to your children when you die. I just can't say it enough how important I think homeownership is. And obviously I'm passionate about it. And it is my business, I know, and I
Yeah.
only make a living if you're selling homes and I'm making mortgages, but it's very personal to me too.
Yeah, it is the American dream. And it is a huge blessing that we have to be able to help people through that. And that's why I just love this industry so much.
Yeah.
Yeah.
I'm going to tell a quick story. I helped a lady who was not a Native American, not from America.
Gotcha.
And she tried to buy a home once before, couldn't, ended up finally doing it. We got it. And it's really hard for me to tell this story because I get choked up. I wasn't able to go to the closing. And she called me. See?
I know.
This is crazy for a podcast. She called me and she's crying. Leaving her because she never thought it could happen.
Oh.
And that's why we do this.
Yeah, we do. Absolutely. And that could lead for her generations, her children, her grandchildren. Oh, I love that. I'm tearing up. I'm tearing up.
I know, it's crazy. It's like, I can't tell the story without getting choked up. So, sorry.
Yeah. I love that. Erin, this has been such a pleasure having you with me today on the podcast. And I'm just so glad that you came. Thank you so much.
You're welcome.
Thank you.
You're welcome. It's been fun. Thank you.